YouTubers, and welcome back to the Independent Investor for October 28th market update. Just thought I'd go over some of the economic news that came out last week from the United States. The economy continues to plod along. This has been a slow recovery compared to ones in the past, but the gross domestic product increased 3% in the third quarter, which was a pretty good number and better than the average. This recovery, the gross domestic product has been about 2.2%, which is quite a bit lower than recoveries in the past. Of course, the 2008 correction was very severe, so the recovery has been a little bit slower, and but the duration now has been longer, probably than average. It also seems to be fairly broad ranged. The consumer durables increased 8.3% over in quarter three, and durable goods is things that typically last a longer period of time, like buying a stove, refrigerator, that type of thing. And so that gives some degree of consumer confidence that people are willing to spend on larger items and typically more expensive items. And same with business equipment spending was up 8.6% annually. So like I've mentioned before, companies really haven't been reinvesting in themselves. They've been borrowing money from the Fed, buying back their stock, trying to drive up the earnings per share. But so it's a little bit encouraging to see business equipment spending up, which is, you know, investing in their companies and in new equipment and they wouldn't do that unless they thought that they could, with the new equipment, be able to sell more product in the future. So that's a little bit encouraging. Also, the Republican tax plan does seem to be moving forward. Trump's agenda so far, he hasn't had really too many wins. The Affordable Care, that was foiled. He was trying to rescind that, and but the tax plan would be good for companies. Originally wanted the corporate tax rate reduced to 15%, and I think right now they're going for 20%. The current tax rate for corporations in the United States is one of the highest around the world, surprisingly, at 35%. So again, that would be good for earnings, and actually good for the market. All that being said, though, the market does continue to increase, and valuations, of course, continue to get more extreme. As we can see here, the NASDAQ just continues to, with very little volatility, continues to increase. The S&P 500, again, about the same, and we're almost approaching 400%. I think at the very bottom, the S&P was 700, so you multiply that by 4 is 2,800, and getting back to the gross national product, only really growing at just over 2%. The underlying economy really doesn't support that kind of valuation, and most of the gains really have just been with the market becoming more overvalued, and doesn't really represent the underneath growth in the economy. As I've said previously. And on Wednesday, we did have kind of a down day, probably one of the worst days we had in a little bit, but of course on Thursday the market bounced right back. But on Wednesday, I think people were starting to maybe take note that the Treasury yields started to, over the last, really since September, start to move up quite a bit. On the 10-year, 30 years, sorry, we've gone from about 2.65 almost up to 3%. And we're seeing that right across. The 10-year now has moved like just over 2%, right up to 2.4, to almost 2.5. And same on the 5, which has actually moved up to the upper trading band that it's been in. Again, we're kind of in this range where it's been for a few months, so it could kind of come down, but it is certainly something to watch. The market really can't, I don't think, can tolerate interest rates going too much higher, because that will at some point impact the stock market quite a bit, because it gives an avenue for people that are already getting a little bit concerned about valuation to sell out of equities and start buying bonds again, especially if they can get, say, a corporate bond at over 3%. I still think the bond market is overpriced, but if rates continue to come up and the bond prices fall, we start getting more reasonable yields, then I'll be looking at that sector a little bit closer. And we're still seeing a bit of a mania on the FANGs. They did come out, Amazon, pretty good earnings, but the share price jumped like 13% in one day, which is on a company that's already very kind of has high valuations. And just on the FANGs alone, their move on Friday was equivalent to about $150 billion. That's just on your Google, your Amazon, and that's equivalent to IBM's overall market capitalization, a company that's been around for 100 years. So just in one day, the FANGs went up in value equivalent to IBM. So again, it's starting to, I think, get a little bit frothy, and nobody knows where this is going to end, of course, but I feel it's time for a little bit more caution as people get more authority about this market, and maybe their expectations are getting a bit too high. On the commodity side, oil has started to kind of finally move up in a fairly persistent rally. We're now over, so we've gone right from 42 right up to 53, and that's the light crude oil futures. And the Brent oil actually went over $60 US last week for the first time. I don't know how far this can go, because typically with so much fracking in the States, and these frackers can make kind of break even, I think around $50 or so. And a lot of them have so much debt that they will bring the wells back online, even just to break even though they're not profitable, because that generates enough cash flow for them to pay their interest on their debt. Also, the OPEC nations, typically some of the smaller producers, their economies are so tied to oil, and there's unrest in the countries because their economy is so tied to oil prices that they start cheating on any OPEC decisions to curtail production. They did come to an agreement late last year to decrease the OPEC production by 1.8 million barrels per day, below the October 2016 like high, and so we'll have to see if they can kind of honor that. But with the U.S. now being able to bring up quite a bit of production, it's hard to tell how this will play out, and I can't really see it going too far higher. I have just one oil. Well, I have Husky, which is kind of finally, I think, a little bit above what I paid for it. I did get in the oil a few years ago thinking it was going to recover, and it didn't really materialize, so I sold out a lot at a loss. Again, it's a sure thing, sometimes never a sure thing in the markets, because you don't know how it's going to play out. At that time, the oil price is so low, stock price is down so low, it looked like a sure thing that it would be a good investment, and it really didn't turn out to be, because the dynamics have changed so much in the oil market. So, but I do have Grand Tierra, which again was a bit like I mentioned last week, Capstone. It's more of a trading vehicle that I've done in the past, and it's just trading around $2, and it can move quite a bit. So it's close to a low here, and it was up. It's been up as high as $3. Most of their wells are in Latin America, Colombia, and the like. So there's some political risk, but it's a little bit more stable there now. But it's conventional rigs, so they basically bring the oil out of the ground at a very relatively low price,